Welcome to another episode of Unstructured Unlocked. I'm your co-host, Tom Wilde.
And I'm your co-host, Michelle Gouveia.
And today, Michelle, we've got a great guest, Matthew Grant from InsTech. Matthew's got a really fascinating background in risk modeling. I'll let Matthew introduce himself, but we have a great topic today talking about how to leverage third-party data to help in quantifying risk. So Matthew, welcome to the show.
Thanks, Tom. Thanks, Michelle. It's great to be on the other side of the microphone, and I need to make sure I don't have
Right.
bad habits that I ask my guests not to have. Very briefly, I mean, as you said, I spent actually 25 years in catastrophe modeling, really saw that from the beginning and really understood the power that insurers can get when you get access to new data, but also some of the challenges. And then just coming up 10 years ago, we started InsTech, and the idea of InsTech is to bring together insurance companies around the world with technology companies and really help both sides understand, what are the most relevant areas of analytics to be looking at, what's working, and try and cut through some of the sort of noise and hype to the solutions that can really help people make a difference in their day jobs.
Perfect. I mean, I think we're very much sort of in the golden age of insurance technology. I think, we have alignment with both the carriers and brokers embracing technology fully and the insureds, really benefiting from that. One of the things that we hear from our customers certainly is that while they get a lot of data from the brokers and from the insureds, it's never 100% of the data they need to try to figure out risk. And in a weird way, insurance is about trying to take the uncertain and make it certain. And that certainty is in the form of the policy premium and the terms and conditions of those policies. Let's talk a bit today about how to use third-party data like catastrophe modeling to help quantify that risk, and the growth in that from things like artificial intelligence, access to data, access to compute power. So maybe set the stage for us a little bit broadly, and then we can kind of drill into some of these topics.
Yeah, I mean, there's a couple of things, Tom. So first of all, if you are somebody outside of insurance looking at insurance, particularly property insurance, you think, how hard can it be to understand where a building is, what's it made of, what's the proximity to hazards like flood? In reality, it's still really difficult, as you said, for insurers to get that information. That's one thing. And then when we look at the world of catastrophes, and catastrophes generally are defined, I forget the exact number, but it's something in the region of a few $1 billion of loss. So it's a kind of aggregation of loss, typically hurricanes, earthquakes, now, of course, wildfires, flood, severe convective storm. Those are things you can't price, analyze, manage actuarially. So this is kind of where models will come in. And there's been 30 years of building these models to help insurers price better, but really to manage their overall portfolios and being incredibly successful, really about allowing insurers to understand what drives the risk, educate their clients how to manage that risk exposure, and then ultimately be able to write more insurance because they got more confidence of what their total potential loss could be. And ultimately everyone should benefit from that.
There's been a lot of, I'll say, just entrepreneurial activity or startup activity in trying to get either better data, so better quality data that's digestible by brokers and carriers, or new data. So something that has been difficult to obtain in the past, a lot of satellite imagery companies coming about, a lot of companies using LIDAR and, visualization to help underwriters or, data scientists better identify what you said, those materials, things about the location. But we hear a lot about there's still that baseline of data that has existed that carriers still want to leverage. What's the best way to think about how carriers approach incorporating these additional data sets into something that they've already built internally that is working but could be improved?
Yeah, Michelle, if you break it down into two parts, that kind of helps us understand it. So first of all, carriers, whether they're writing homeowners, commercial, will have somewhere information they need about their policyholders. And that's not just in the new business also. And the challenge is actually how do you get hold of that information, because a lot of these systems are running on legacy. So you're seeing quite a lot of work going on to be able to actually help people manage across different silos. And then the second challenge is once the data comes in from the underwriter, sorry, from the broker, how do you efficiently extract that data so you're not rekeying it? So there's just a sort of basic, I'd almost call it hygiene. The data's there. I just can't get my hands on it. If I'm an underwriter, I can't get my hands on it easily. We're starting to see a lot happening. A lot of that's being driven by generative AI ability to ingest data. The second one, though, is when you look at this third-party data, you're right, there's a lot more data coming in now from things like satellite imagery, as you said. There's some quite intriguing things going on with sort of cameras on the ground, sensors. The big challenge, though, is it's not really a technology challenge. I mean, I trained as an engineer, and I remember my first boss saying to me, the difference between an engineer and a scientist is a scientist can almost get anything done with enough money and time. An engineer gets it done at the right price on time. And it's a bit like that when you're trying to extract data. There's only a certain amount of money that's available really to assess a risk, because you've only got a certain amount of a premium as an underwriter, and you're going to decline risk. So the reality is, yes, there could be companies that come up with really clever ways to get information, but the real barrier to adoption was two really. One is, can you do that? Can you provide it at a point that is cost acceptable to an insurance company that's probably already using some analytics? And the second one is, because they're making decisions on this data, how confident can they be that your new aerial imagery, location level data about your property is better than what they're seeing either from their broker or client, or they've got on their systems? And those are two really important thresholds to think about alongside the ability to do it. Is actually not just the ability, but actually how confident and how cost effective is it?
Do you think, is AI changing carrier mindset around whether they should be building proprietary predictive models or just being good at integrating them? If you kind of follow my distinction here, are they more likely to think, hey, we can make this a competitive advantage if we have our own proprietary models? Or is it really just, let's take best in class and be really good at that synthesis?
No, I mean, Tom, it's a great question. And the answer is, there are definitely companies out there seeing this as a competitive advantage. I mean, you'll know this well. Your listeners are probably familiar with the technology adoption curve. Essentially, companies, individuals move at different speeds. Some of us queued up to get an iPhone. Some of us waited 2 years until it had been properly sort of robustly delivered. And insurance companies are the same, and people in insurance companies are like that. We did an event in London a few weeks ago, and we had the head of modeling for Zurich Insurance, one of the biggest insurance companies. He was really excited about, and when the Swiss get excited, you know to pay attention. He was really excited about the use of AI for them actually to be able to build their own models, and they built a terrorism model using AI. And this is an individual I know he's an engineer. He's very thoughtful. They were definitely seeing a competitive advantage because the generative AI tools now and other more traditional AI tools do allow you to much more quickly perform the analytics and deal with that uncertainty in there. So yes, there are some doing that. I think that I'd say, most of them, just because where we are on the technology adoption curve, are probably looking for uses of, and I'm just going to keep talking about generative AI because I think we can all intuitively understand it. That's more on what Michelle was talking about, which is the efficiency play. How do you more efficiently get data in? How do you more efficiently sort of write emails to your brokers and your clients? But I can talk a bit more about there's some parallels of what happened in the past about how some insurers started to use analytics, when we were still using spreadsheets and didn't have AI, but I think we can see playing out here as well.
We've made this distinction a few times about data coming in and using it, and I could be wrong in how I'm thinking about it. So please do correct me if the piece of this question is wrong. But using AI to do the actuarial modeling, potentially using the data that you're getting, and then there's using AI from an underwriting standpoint as that information comes in to add some efficiency. But those two things do need to be in concert with each other because you need to be assuming similar things about your whole portfolio or book of business. So I'm curious if you think that from a cat risk perspective, it's more imperative that AI be used correctly on the data scientist side or on the underwriting side?
Well, I'm tempted to say both. I mean, the answer is
Oh, yes. You should do it accurately on both. But what's the driver maybe of adaptability?
I suppose I might disagree a little bit. I think you can do this incrementally and in steps. And I mean, the example I just used was Zurich, and they're doing this for one book of business. So, most companies in life, we don't change overnight. So what tends to be happening, people might be looking at one area. Say, for example, severe convective storms, tornadoes, hail, really hard to model traditionally we probably all know these are happening more frequently. AI can actually provide much more sophisticated ways to actually do some of the analytics around those and understand them. That in a sense is picking out where traditional models have failed. So you could have an insurance carrier goes, right, we want to focus on our severe convective storm risk exposure and understand more about our portfolio, understand more about our aggregation. Now that's partly that's underwriting, because the underwriter, part of good underwriting is you don't write too much risk in one place. You got to manage your aggregation. Your data scientists and mostly people as well, and they are also recruiting now PhDs who have built models themselves. So to your point, they've got the skills internally. They know the limitations. They will basically look for areas that the traditional modelers haven't been able to solve or haven't chosen to solve, test it out. And often what happens is you see this, so you get your kind of leadership advantage about building your model. And then 2 years later, there's a commercial model available, and you start to sort of see these companies saying, well, actually now the commercial world has kept up. We don't need to keep building our own model, but they get that early advantage of understanding more about the risk. And one thing, it's worth mentioning as well is it's always tempting when you think about insurance to think about insurers saying no, but actually underwriters like to say yes. And one of the interesting things that Sarah Russell, who launched Bellwether out of Alphabet or Google X, was saying, when we spoke recently, was that what they're looking at is where the industry may have a perception that the risk of wildfire is too high. If you've got confidence in the data and you use the analytics well, you can identify where in fact the actual risk is not as high as it might be perceived, and therefore you can offer insurance and you can take advantage. So I think it's really important to understand that's an early mover advantage is if you trust your model and your data, you can actually take, and everyone benefits. People who couldn't get insurance can now get it. And we're seeing quite a lot of examples of that in different ways, of people being innovative about better pricing of risk, because for all the reasons we talked about, you can be more confident and more accurate.
The reinsurance folks have been super active in this for some time, right? Swiss Re, Munich Re, those kind of folks with catastrophe modeling and other models that they're commercializing. Talk about, is this access to data? Is the commercial incentive to really help, sort of their collection of customers? Where does the reinsurance segment play in terms of this category?
Well, it's a little bit like I just said, actually, Tom, without giving away any secrets. Munich Re, Swiss Re, as you said, were really there amongst the earliest of 25 years ago, along with the Bermudan companies, about building their own models. The benefit they had, of course, is because a lot of their business is not intermediated by a broker. They get direct access to the insurers. They get access to claims data. So access to claims data is really important when you're building a model. So they were able to build models, but the reality was, at some point, they too said, right, actually, we've gone as far as we can. We can either, probably magnitude 10 investment in modeling, or we go and work with some commercial modelers. So they've been quite sophisticated there about looking at, again, classic build versus buy model. And reinsurance traditionally wanted to be quite agile. And, London Lloyd's is probably, when it works well, one of the best examples. You have a very lean team. You kind of work out where you buy effectively your analytics and you don't really want to build up a strong modeling team, even if you could. So I think their skill, I'd say, is yes, they'll build it when they need to build it. But if you've got a commercial solution that works, and particularly you can actually tweak the dials and levers so it can represent your view of risk, we talk about what that would mean, then you'd be better off buying commercial. The same way, would you build your own computer these days, or would you go and buy one off the shelf from Mac or whoever else you're buying one from?
And thinking about how fast AI moves and how quickly decisions, one, get made via AI, but that carriers need to make about using AI, what do you foresee, or have you seen the concerns about leveraging AI more so in the cat modeling? And what is that, I'll call it, review period, or how long is that decision-making tail to say this really is additive to our modeling, or it does improve our underwriting, approach? How does that change now with AI being in the mix?
Last year I talked to a few people in the roles who were, when we talked about building models, assessing models, and they were basically not allowed to use ChatGPT at work because the insurance companies are still trying to figure out, what is this new tool? How dangerous is it? You can't use it at work. That was a massive barrier to what they were doing. That's now changing. And the second area about AI and the use of AI is the regulators. And we all have heard about how the regulators are concerned about the use of AI for consumer applications. Insurers are really careful using it there. But of course, when it comes to catastrophes and insurance pricing, and every US carrier will be very familiar with this, in the US, the ratings have to be filed, to be approved by the insurance commissioner. The insurance commissioner is a political post. And so there's been quite a few situations that we've seen, and most recently in California with wildfire, where the regulator can make it really hard for an insurer to use a model that looks at the more recent history and is pushing back on longer term views. And so even though AI might be there to actually give you a, inverted commas, better answer, because there's still a constraint on using it. And so therefore that business, fortunately, London is there as a market that will pick up what is being declined in the US. But that's a really important one to remember, because the regulators have got such an important role to play and we just see how slowly that they come back from that. I mean, they have now changed their mind on wildfire in California, but it does, Florida still goes through a really expensive process for reviewing the hurricane models every couple of years before they're approved for rate filing.
Do you think that, if you mentioned Google X, which I think is a pretty fascinating idea, creating a digital twin of the Earth. Is there a point in time where, catastrophe model becomes much more certain and much less, perspective? Are we on a path to that? If you look at the availability of data, availability of compute, the availability of AI, are we on a path where, there's much more certainty around things that today seem very uncertain?
It's a curve, and you get sort of closer to the knowledge, but you never get to the full knowledge. And the challenge is, nature itself is in the short term is very unpredictable. In the long term, you can predict it, although of course climate change starts to add another dimension to that. It's hard to totally predict. So I would say the answer, Tom, is, if you look at, let's take a hurricane model to make it very specific. Hurricane models have been around for 30 years. They've been through 3 or 4 generations. You get hurricanes every 2 or 3 years. So there's good loss data to calibrate them with. I would I'm sure somebody will take me up on this, but the potential to get a better hurricane model now is really, certainly for the US anyway, is really marginal. They're not really going to get a better model, but we've still got all the massive uncertainty. You saw it last year about what is the hurricane activity going to be, even looking at 4 weeks into the season ahead. Last year was a really strange year.
2 hurricanes within like 3 weeks on the west coast of Florida.
Yeah, exactly. But then nothing for most of the season and one at the very beginning. So you've got that short-term uncertainty is huge. You've got the physical characteristics of the hurricanes are still really quite surprising. So I think, answer to your question, and this is kind of where the underwriters have that advice. This is kind of what their skill is you're working in a world of uncertainty. How do you understand and be aware of uncertainty, but still make decisions and not get paralyzed by the uncertainty in there? So I'd say the other thing is, although catastrophe modeling has been around for 30 years, mostly it's been for portfolio management, and it hasn't really been fit for purpose for individual location level underwriting. Flood, if you try to use a model to price flood, watch out, because there's about 30 variables in there between when the rain falls and how much goes in the ground. You're kind of kidding yourself, really, if you're going to try and use that accurately. Now, I can give you an indication, but you shouldn't be trying to use that solely to price.
There's always this tension between, should an insurance company be in the business of sort of loss prevention or loss protection? In high risk areas, it still seems that it's very slow for insurance companies to play a more active role with the insured in helping them figure out how to avoid losses in the first place. We've seen examples from the Palisades where some houses survived, very well, and the next door neighbor would completely flatten. The same is true of the Florida hurricanes. You see those aerial photos where 5 houses look pristine, amidst a debris field. What is that a changing attitude, do you think, or will it continue to be more, sort of passive that, hey, if it happens, we'll pay for it, but we're not really in the business of helping you prevent it in the first place?
I think the carriers' credits, insurers' credit, they want to help prevent it. If you like, Chubb have got a big sort of mandate to prevent, and that, and of course you've got to distinguish between homeowners and commercial. but even in commercial, it's really difficult. And I mean, insurance transactions, it's a grudge purchase.
Yep.
Most people, either they're buying it individually or they're with a broker. It's just like, you want to get it done. You kind of shop on price. If someone tells you, well, you've got to prove show me photographs because you removed all the vegetation or things like that, it just gets in the way of it. And so I think that's part of the problem. I mean, in Florida, and I think this is still happening, a few years ago, but there were insurance companies that were providing credits. And I think even the government was looking at this, where if you had your roof tied down in a certain, or nailed down in a certain way, you use tie downs,
Yeah.
you would get credit on it. But I just want to add an example. It's a while ago, but there was Andy Thompson, who's now got his own business safeguarding sensors for earthquakes. But for a number of years, when he was at Gouveia as an engineer, he was looking to see, could he help his clients pay for the cost of retrofitting for earthquake with a reduced insurance cost. And it was virtually impossible. And part of the reason for that is what happens, back to the point about reinsurance, is particularly in this excess and surplus lines, where you've got, high risk businesses coming out of the US and being insured by people that are focused on these high risk areas. They might be able to give a favorable price because they, the transaction level with the client, they see the benefit. Unfortunately, when it all gets rolled out for reinsurance and you go out to the market, the reinsurers probably don't allow for that because it's just out of the normal. And so unless you're a company like Factory Mutual, where your whole business is based around insuring people that have got better engineered structures, unfortunately, at the moment, there's a lot of friction in the system to actually make what should be in everyone's interest ultimately work properly.
What's always struck me as peculiar as a consumer, like I've never gotten, a sort of risk report card from any of my insurance companies about my house, about my health as it relates to life insurance, about driving patterns. And it just seems like that would be very useful. But I've never seen any such thing from any insurance company I've ever worked with as a consumer. Obviously, I find it a little bit peculiar because they certainly have this data. They're using it to write the risk. Why don't they share it and say, here's some things that will, long term protect your property, your life, your whatever it might be. So it's interesting.
I'll tell you why, Tom. Though, I mean, I've got a theory. I mean, you and I,
Yeah.
I'm sure Michelle, we're responsible citizens. We maintain our property, we look after it. And you've seen this happening with telematics and driving as well.
Yeah.
Essentially, if people are going to start offering us discounts, then at the moment we're subsidizing all the people that are, not as diligent as we are. It doesn't work. You can't go and charge people more because somebody else will undercut them and price it. So there's just, again, it's a little bit of friction in the system about why that doesn't work. I mean, so I think that there is a reason for it. I mean, call me a cynic, but I just don't think it's going to change anytime soon in that model.
Right. If you tie it to pricing, I agree. That becomes a challenging one.
The carriers have tried it or are probably still trying it. I was part of a team that was trying it at one of the carriers I worked at for a bit. And they're outside of what Matthew said, which is a limiter for sure. There's also just that constant desire to make sure your data is accurate, or how quickly does it change? So that constant question of is our insured even going to care? Because if I get one data element wrong on this, they're not going to believe any portion of it. And then there's the what does that really drive from an engagement standpoint? Is it better that I'm giving them this information that I know I have, they may not know I have? Does it harm that relationship? And then what's the best way to communicate it? I think there's been partnerships with Google Alexa before. Are they mailers? Do you send them out as part of as the quote or post bind? So there's just a lot of just like execution questions there. I don't disagree that it makes sense to come from those people that are the ones like assessing you based on the data that they have. But I think there's just a lot of concern for miscommunication as part of that. And so that's another challenge, more of a qualitative challenge.
Can I give an example actually as well? This is motor again, and it may be anecdotal, but I remember hearing on a podcast from the founder, I think it was by Miles, and they were saying that, and I don't know how this works in the US, but in the UK, when you take out auto and motor insurance, it asks, where is your car parked? Is it parked on the road? Is it parked in your drive? Is it parked in your garage? And when people said it's parked in their garage, they actually loaded up their price because it was actually turned out that's a leading indicator for fraud, because unless you live in somewhere like Minnesota and it's snowing, all year round, all the winter. But, certainly in the UK, the weather's never so bad. You need to put your car in the garage for a day or two of the year. So the point being, people who said I put it in the garage are on balance probably lying because they're trying to game the system. So actually penalize them because they're lying at the point of entry. So it's sort of, even when you ask people for that information, Michelle, a bit to your point, there's sort of, what are they, are you going to validate what they said, or do you have the risk they've actually lied to you and then you've got an even worse exposure because A, they're lying, and B, they don't have the protection in place they told you they did.
So maybe the obligatory wrap-up question, what jumps out at you is sort of the biggest changes to this category, catastrophe modeling and third-party data kind of in a 3 to 5 year horizon?
I think it's where you started, Tom, which is what I find just tremendous is there's so many more companies coming out now to help and offer solutions for just the different parts of the value chain of solution. Whereas, and I worked for one of them, 5 years ago, there were 2 modeling companies that pretty much dominated the space. We were worried about hurricanes, earthquakes happened at those stages. Today, you've got all these new perils coming out. We didn't talk about cyber, but that's out there, liability. There's more granular data. We've got better access through platforms. You've got the generative AI. The cost of building a company is much better. There's more capital around. Thank you, Michelle. So what we're seeing, and again, we sort of source evidence by our recent conference and some of the people we're talking to, a whole lot of companies that are coming out and really quickly offering value around the margins of what the core companies are doing. And also what's really nice about this space is that it's really collaborative. And because a number of insurers might want to use 2 or 3 models or data sources, the competition is not as aggressive as it might be somewhere else. There's room for everybody in that space. And so you get this really great collaborative effort. So I think, what do I see coming? I see more companies offering real value, probably more niche rather than dominating the market or mainstream. But they're all, the good ones are performing a really valuable service, and there's money there. And I think, as I said earlier on, they're actually helping people write and offer more insurance as opposed to more reasons to say no.
Great. Well, Matthew, thanks so much. We've been talking to Matthew Grant from InsTech. I am your co-host, Tom Wilde.
And I'm your co-host, Michelle Gouveia.
Thanks, Matthew. Great conversation.
Thanks for joining us.
Thank you.